You're listening to Questioning Your Sense, where you get real-world, pragmatic tax and financial advice for business owners, entrepreneurs, and independent contractors. Here are your hosts, Kevin Molen and Charles Steinmetz.
Hey folks, welcome to Questioning Your Sense. I'm your host, Kevin Molen. With us is our co-host, Charles Steinmetz.
Hello.
Charlie, how you doing today?
I'm doing a little cold.
A little cold, yeah.
A little cold.
So to preface that, we are in Houston, Texas, and it is February the 19th. We just finished a freeze of essentially our entire state. It's been very interesting. So a lot of us were without power, and some of us are still without water. But we are here bringing you the peak content that you expect. So
I know it's small violin to a lot of folks that live in different parts of the world, but it's different for us. Okay, it's just different.
Well, our governmental system just isn't set up to withstand those type of temperatures because it's highly unusual. I lived in Western New York for a couple of years and drove through a lot of snow and dealt with a lot of negative temperatures, at least in Fahrenheit. And yeah, I mean, this was cold, but it wasn't dramatically colder than I've experienced before. The problem is we don't have snow plows, right? The city doesn't own giant, quantities of salt to help, Houstonians drive and all that kind of stuff. So we just don't, there's not the governmental systems in place because you don't need them. So
we have power grid issues. I think each of us fled our own homes at one point during the week too.
Yep, so. Absolutely. But like I said, we're here bringing you the content that we love to bring to you and that hopefully you enjoy consuming. So we'll go ahead and get started. Charlie, is there anything in particular you want to tell me about today?
It's all going to be related to the same thing we just talked about. Have rice on hand, have noodles on hand, have water, do your food storage, because it's important.
Have a gas stove.
Having a gas in your house was important.
Well,
that's where I fled to a house that had gas stuff. I had my camp stove, my propane going that first night there. I did, absolutely. But yes, those kinds of provisions. I ended up working.
Yeah, I think that first night we had chili. It was lucky because we had made chili just a couple of days before. Sure. And so we just reheated all of that, and it felt amazing because we were eating like barbecue chips leading up to that. With no power.
How about you? Anything you'd like to tell me about, or is it along the same thing?
Yeah, so there's a couple things. My wife and I got the COVID-19 vaccine, and so starting tomorrow, she and I are now immune. So feels pretty good, kind of like Superman. Even if I come into contact with somebody who has the virus, I don't have to quarantine, which is fantastic.
So what's your plan? Just like kind of tattoo, vaccinated, that way you don't have to wear a mask or anything?
No, technically the advisory is still to wear a mask.
Still wear a mask.
Just to try not to, because it's only 95% effective and all that kind of stuff.
I want you to get a tattoo.
That's not happening, Charlie. And so then actually I have two things. So then the second thing that I ran into, I was so this is tax season, busiest time of the year for us, chock full of appointments. And so I was working with somebody yesterday who, there were some changes to the mortgage interest statement form, kind of that tax form that you get for having a mortgage, about 5 years ago to include the mortgage origination date. Yeah. And so I can look and see when that specific mortgage was originated. And I saw one from 2002. 2002 is quite some time ago. The interest rates then versus the interest rates now, to have not refinanced a loan since 2002 is very unusual. And this was a unique situation because I had somebody who was looking to retire in the next 2 years. They had a deferred comp type account, kind of like a 401k, had about $70,000 in it. What they were trying to figure out for me is how can we take that and remodel the home in preparation for retirement. So they didn't want to wait until they were retired to take the money to remodel the home. They wanted to remodel the home leading up to that point. Sure. And so you could take a loan from these type of accounts. You could take there's a few ways that you could probably figure out a distribution from those accounts. But those ended up having some pretty rough tax impacts. Sure. And so I was looking at that mortgage interest statement form and I said, you know what? This is probably one of those scenarios where you could refinance, and they had about 9 years left on the mortgage. You're not going to find a 9-year refinance, but you could bump it up to 15, right? So from 9 to 15, from a 6.2% interest rate, which by the way, is not all that awful from 2002. No. That was probably a pretty good rate in 2002, but still horrible now,
Compared to
right?
now, especially right now.
Exactly, because rates are so low. And so what I offered to them was a potential solution of refinance with cash out refi, right? Take money from the refinance, bring the rate down to 2.8 or 2.5, depending on their credit.
Pulling money out makes it go up.
Yeah, and increase the years, right, from 9 years left on the mortgage to 15 years left on the mortgage. And then if they really so desire, when they retire, they can just take the $70,000 out, paying $7,000 less in taxes, and putting the money directly toward the mortgage. And so that was one of those financial opportunities. It basically was one of those education-related opportunities. I was able to diagnose something that they hadn't considered that was really low-hanging fruit and was refinancing was a pretty good idea anyways. And so they were thrilled for us to kind of discover that and talk through it. And really this particular tax return is not incredibly complex. And so someone like that may say, oh, I could just do my own taxes on TurboTax. Sure, you could. What you lose is the expert financial viewpoint of your finances, your taxes, and all of the different ways that you might be able to be more financially successful than you currently are. And so it feels good to bring value to someone who has not a super complex tax scenario. And it was a really good illustrator, if you will, for our listeners that you really need a financial expert. You need a tax person who's looking through, everything that you have going on, because they're going to be able to diagnose things. And not every situation that I have is like that. But there is always something that I'm going to, be able to enlighten my clients about and spend time educating them on. Our guarantee at Molen and Associates is that you will learn something new every time you work with us. And I think we deliver on that quite well.
Awesome.
So I know that was lengthy, and it was 2, not 1, but I did want to tell you about a couple things today.
The whole thing on its own there.
So the topic of choice for today is in regards to the 2020 tax season. So obviously it's 2021. We live a year in the past. And so whenever I say last year, I always mean 2019 at this point. When I say this year, I mean 2020, even though we're living in 2021. Such is the life of a tax professional. But living in the past, so the 2020 tax season, in particular, we carved some special time out during this tax season because we wanted to make sure every tax season kind of has its own pulse. And so every tax season can be a little bit different. There are some oddities, some unique things. And so what we're doing is we're trying to record this really quickly and send it out to you as quick as possible so that you get a feel for where things are at right now. Maybe you have, you're starting to get all your documents together, you're starting to look to file your tax return, or you're scheduling an appointment with us and you want some insight before coming to see us. And so all of this will be helpful. But in particular, Charlie, you want to start us out in regards to kind of some of the delays that we're dealing with?
Sure. So it was right off the gate, basically, to the electronic filing date got moved to the 12th. Now, why that's important...
February the 12th.
The 12th of February is correct. Thank you. It's important. But historical on that, why that's important, and it's not as bad as it sounds. Every year in November-ish, the IRS shuts down essentially their computers to write program code for being able to handle new data, the next tax season. And so most of the time, end-ish of January, it's back up again. You can do your tax returns, no problem. When things get changed on them, the IRS reacts badly, and so they just needed more time, in their opinion, to write and do their homework, basically. And so they picked a date, and they said February 12th. And so that was the date that they were going to open the ability to electronically take in new data. What was different, in addition to that notwithstanding being different, what I felt was more unique with that was the IRS did something else connected to that date that I didn't know that they had broadcast necessarily, which was, as they're prepping all this data, they put watermarks on all their forms that say do not file, It's in draft mode, And so with typically January getting released, they put those forms out. People can print and prep those forms, and those who really want to can mail that stuff in early January to get that stuff started. It doesn't really save you any time. It's not that great. Please e-file. However, this year, maybe because of that, but maybe because of this 12th thing, they felt they had more time. What ended up happening is they put those watermarks on every single form. I, in a decade, have never seen the 1040, the main tax form, name, address, here's how much I made, be in draft mode in February. So even if you wanted to print it and send it off and say, I'm done, my taxes are in.
You couldn't.
You could, but it said do not file. They should do it.
The instructions
Turn it
were
right back
very
around
clear.
again. What you do.
The instructions were very clear not
This is invalid.
to mail it through. Yeah, it's really unusual because in my career, I've worked in the tax industry since I was 10 years old at a family business. During that entire time, 25 years, I have never seen the IRS turn on electronic filing any time outside of January. It has always been in January.
Right.
And a lot of people like to file tax returns, especially the simpler ones, as quickly as they can and get their money back because they know they're going to get a refund.
Right.
If they've got a very basic tax return, they get a refund every year. Nothing dramatic changes. You still get a refund.
Correct.
And so it was really highly unusual for them to push the filing date to February the 12th.
Correct.
Now, that isn't really super helpful for you to know about now because, again, the time of this recording is February the 19th. So obviously electronic filing is already open, but that does not mean that it will have no impact whatsoever on your filing. The IRS is processing tax returns in a shorter period of time now than they were.
Correct.
Because had they opened in January, they would have had more time to file, more time to catch issues in their systems and all that kind of stuff. So it's just really unusual. People are filing tax returns like crazy right now. The IRS is going to have to process a ton of them because they've just been waiting. It's the dam that has just been holding back all of these filers, and now suddenly it breaks.
And it's like they haven't had an entire year of backlog information already in their system.
Yeah.
And now they just set themselves up for another wave of backlog.
You mentioned that, and it's worth mentioning a couple of points. Number one, ideally, electronically filed tax returns go around the human factor at the IRS, okay? Because their budget almost never increases. Every year, they talk about how they need technical support and the human aspect, right? They need more manpower, and it's almost never approved. But they are so backlogged because of COVID-19. They had people working from home a large majority of the year. There were plenty of IRS calls where you call, you're talking to somebody, and you hear their kids in the background, and so anyways, the IRS is super backlogged in regards to processing anything sent through on paper.
Right.
So letters that we have sent, responses to IRS letters that have been sent out, and that kind of stuff. The IRS is still sitting on. They haven't even opened. I've got stuff that I sent in the middle of the year last year that the IRS has not responded to yet, which they're always a little slow, but that's highly unusual.
The zero response is not fun. Often they'll send a, hey, we got it and we need 90 more days. And they just keep chaining those every 90 days.
And at least know.
Correct.
Yeah.
But the no response has felt weird.
Yes.
So it's been weird for a while. The February 12th wasn't any more weird than it has been for the past year.
But that it's just evidence that they're really far behind right now.
Yeah.
Now, ideally, again, electronically filed tax returns go around the human factor.
Correct.
They eliminate the need for significant manpower, which means that traditionally electronically filed tax returns aren't delayed even when the IRS is delayed. For example, last year, during the 2019 tax season, which again, we live in a year in the past, that was in the year of 2020, the IRS was just coming off of a whole bunch of furloughs, right? The federal government employees were furloughed. I fully expected them to be really significantly delayed. And they just weren't. They weren't.
They opened e-file, I think, the earliest in the past couple of years. They did really good.
Right. Now, the IRS was delayed, but the electronic filing was not delayed, and refunds were not delayed. So what I'm telling most of my clients is, look, based on all of the evidence, I would expect refunds would be delayed this year. But based on all of the evidence last year, I would have expected refunds to be delayed, and they were not. Which leads me to think that assuming they have the same systems and everything set up and all the same efficiencies to the whatever extent that they can electronically, that refunds based on last year's evidence probably won't be delayed this year. Now, we don't know. I don't have a secret, connection to the IRS that's telling me that they're going to get these out lickety-split. But that is my expectation based on the evidence from the previous tax season.
You choose how you feel, and we choose to look at it as glass half full. That's what we choose to do.
Kind of dangerous with the IRS.
It can be.
We'll do it.
Well, one thing very recent with that is as they release forms, they don't do them all at once. They do them in most of order priority. Now, they released a lot of forms immediately. There were a couple that weren't released on the 12th. One that just came out a couple of days ago was one called the 8915. That 8915 is unique. It's been around for a little while, but it matters to people in regards to things going on right now and last year. So there was this, the CARES Act that had passed, a lot of things. One of them was allow you to take money out of a retirement account, period. And then potentially, based on circumstances, you could eliminate a 10% penalty, spread the taxable amount over 3 years. You could do some good things to minimize the tax.
Yeah, let me speak to that a little bit because I think you glazed over the important part here. Specifically in regards to why this exists, the CARES Act was passed in response to the COVID-19 pandemic.
Right.
So this is one of those scenarios where it allowed for people to take distributions from retirement accounts who had negative financial impact due to the virus.
Right.
And so that piece I think is an important piece. But yeah, this form was delayed after the 1040 and all this other stuff,
Correct.
right? So the form 8915, if you took money out of a retirement account because the CARES Act allowed you to, you may qualify to be taxed on that distribution up to $100,000. That's the max that you were able to take out. You may qualify to pay tax on that distribution over a 3-year period,
right,
without paying a 10% penalty, which is pretty significant. I mean, that's a pretty big deal to be taxed over a 3-year period because of the way that tax brackets work. The more income you earn,
right,
the higher rate you pay. It is progressive, and so you kind of fill up these pockets of tax brackets as you go.
Right.
So when you stack $100,000 all onto the rest of your income that year,
Correct,
even if your income was reduced by the virus, it's still a tremendous amount and will very likely eclipse you, and a portion of that may be taxed at a higher rate than you would have
right,
if you get it taxed over a 3-year period.
So I had, as in a real world example, I had an individual, I'll change the numbers so it's not real, but they were on the higher side of income, however, for what would count, but still taking it all at once versus spreading it over 3 years was a $15,000 difference in tax to this individual because of circumstances. You get to count all the federal withholding now and then push the rest, the other 2/3 of the income over, the other years. And so we're limiting 2/3 of potentially $100,000, getting rid of $60,000 of income.
Or even better, don't have anything withheld at all.
Sure, I had a couple of those who did that.
Keep more money in your investments,
Mm-hmm.
because taking money out of your investments in 2020, bad move. 2020 was a great year for the market.
Right.
This is part of the difficulty, right? Because the market did very well in 2020. You wanted to have as much money in those accounts as you could. And we didn't know that ahead of time, obviously.
Right.
My crystal ball is broken, unfortunately, at the moment, so I can't tell the future. But I always advocate, if you can, leave as much money in the investments as you can. Retirement accounts are exactly that. Retirement. That is what they are for. But I think I cut you off. Sorry.
No, it's no problem. No, it's just that. So again, just because it was a pandemic doesn't automatically qualify people. Again, there were different stipulations. Just because you were able to access your 401 and pull out a coronavirus distribution doesn't necessarily mean that you're met the qualifications for excluding that part. So please consult with a good tax advisor to go over if you meet those things.
In fact, you brought up that they made them a little more stringent than they had originally determined.
I meant to print it. I'm not going to print it.
That's okay. That's kind of a sneaky move, right? Because initially it was
pretty open-ended.
If you were negatively financially impacted by COVID-19, it's kind of like, well, just about everybody was negatively impacted. There's a lot of reasons that you can come up with. But then they ended up...
But like example, ABC, like these things.
Right.
And so, like I said, talk with someone and we'll be able to go through that with you to say, hey, this yes or this no. And I will fight as hard as I can. I pulled him out of a meeting the other day to go over how can we interpret this and still interpret it well and stand on good ground and it fit. Yep. So maybe no, but we will absolutely do what we can to make it yes for yourself.
Yeah, ultimately the question is it defensible, right?
Yeah.
Because if you can take a position on a tax return, even one contrary to law, that is defensible, The IRS is not the final authority on what is approved and what is not. Now, if you disagree with the IRS's determination, you have the right to take them to appeals, essentially, and eventually that can go to tax court. The IRS loses about 50% of the time in tax court. And they lose.
They use the law.
Yep. And they lose 50% of the time using the law as it's written. That tells us that the law is not sufficient. And so anybody who sits there and says, well, I know the law, and so this is how it is treated, I just sit back and think, that's fine, you think that, but
Right.
I know the reality. The reality is the law is not sufficient. It's just like criminal law. Two people can commit the same crime and get wildly different sentences because one was premeditated and one was a crime of passion, or one was a first-time offender and one was a habitual, crime committer. And so anyways, the point is that people think that taxes work like a light switch, right? It's either on or it's off, it's right or it's wrong, it's black or it's white. And that's not the way that income tax law works. It is based on individual facts and circumstances in accordance with the law. And so you have to use those
Correct.
facts and those circumstances to determine whether something is applicable, whether you can qualify for it, and you can stretch those definitions. And so that's part of what Charlie and I were talking about in regards to the client that you had, because we were both sitting there with our years of experience, and again, over 15, probably 17,000 different financial scenarios at this point that the two of us have dealt with over the course of our careers. And we're sitting there back and forth. We're both thinking our own ways of, well, what about this? Well, what about that? And all the different circumstances surrounding it. And so anyways, but it's important, like Charlie said, it is important that you get competent tax advice in regards to especially these distributions, because what they said originally versus now what standard they are holding people to are not the same.
Correct.
Yeah.
So look at current information. All right, so let's pull us back to our topic. So we talked about the February 12th and those pieces. So the next, I think, thing that has been affecting our immediate tax returns and clients has been the stimuluses we have already received. We're going to talk about the other one later, but the stimuluses that we have already received.
Yeah, so depending on when you're listening to this, right, so let's clarify that the April.
I tried to be clear, and it doesn't work.
That's okay. It's my specialty, Charlie. Being clear. So initially the April 2020 stimulus, right? So that was the $1,200 stimulus that increased to $500, or that had a $500 stipulation for dependents, and then the $600 stimulus kind of across the board that was passed in December of 2020. I received mine in December of 2020, but a bunch of people received it in January of 2021. So specifically in regards to the stimulus payments, we'll call them round 1 and round 2. Okay?
Sure.
So round 1 and round 2 of the stimulus payments. The IRS wants to know how much you received, which is ironic because they're the ones that gave it to us.
Right.
But it's more complicated than that, because essentially, if you go back and actually listen to some of our podcasts from before at the start of the pandemic, we actually spoke about this because our expectation, based on what they told us at the time,
and how it was written, then
exactly, is that when we file our 2020 tax return, depending on how much you received for the first and second round of the stimulus, which we didn't even know there was a second round at that point, right? Everything was based on the first round. But depending on what you received, you may have to pay some of that back, depending on if your income increased beyond certain thresholds, or you lost certain dependents, things like that, right? Because it was an advanced credit from the 2020 filing. And so now here we are filing the 2020 tax return, and they have just walked it back. In a good way, they're saying we're not going to reconcile, is the word that I'm using, meaning what we paid you versus what you should have qualified for. We're not going to reconcile if you actually should be paying some of it back to the IRS. So you're not going to end up having a negative ramification for having received the stimulus amounts to begin with.
Right. There's like no bad connotation. Zero.
But they are allowing you to claim what's called a recovery rebate credit. So now what we're saying is if you didn't get enough,
Correct.
we are going to actually pay you the difference.
Correct.
So they're going to reconcile the good way and not the bad way.
Correct.
And
So
I realize
worst
that's
is
like
0.
5-year-old talk, but
Yeah.
it does communicate the point pretty clearly.
And it doesn't matter if you got this round 2 in January, December, where there's entries for it, input for it to go in. That's the reason they're asking for it, is simply should there have been more so that you can capture it, or is it 0 because you're not giving you already got enough or too much and you have to pay it back, but 0, which is great. So it's not a bad thing. It's not going to hurt your taxes. If there's anything wrong with anything.
Yeah, it's not taxable income.
Correct.
You don't get penalized for having received more. You don't have to pay any of it back. I don't know how many times we have to say that.
Right.
But every time I ask somebody about it's been so many appointments that we've had so far. And every time I ask somebody for the second round, they go, well, that was paid in 2021. I'm like, that's okay. This is just informational, right? This isn't going to hurt you. And it's like they don't believe me the first time I say that, so I have to say it a couple more times before they actually, agree with me.
Yeah. So now there is rife, riddled, fraught, whatever vocabulary you want to use of potential oddities with this, between people being divorced, kids being born, kids turning a different age. There's all kinds of stuff with that. We're not going to, I think, dive into that here, but the IRS is set. It has been set up for the IRS. They didn't cause this. Set up for the IRS to have some question-answer sessions. I think that will go forward for some folks of hey, we think this, but you put this, and there's going to have some differences on there. So whether that's in the form of projections or letters or just changed refunds or whatever. So we're doing the best that we can with that information now. You got this, we report this, and dealing with it, and then sending that off. And
just as
sadly, it's a wait and see.
Yeah, just as a quick explainer here. Let's say that you've got husband and wife who are married, filing joint tax return in 2018. But they have since divorced at the start of 2020. Okay, very beginning, January of 2020, they're divorced. Neither has yet filed their 2019 tax return. So they filed married filing joint on the 2018 return. Then they're going to file their own returns on the 2019 year, essentially. I'm trying to give you the quick explanation, so please understand this is
just paint a bad scenario and say, here's why it's bad, and then...
Yep. Essentially, whatever account they had their refund, if they were getting a refund, whatever account they used on the married filing joint return to get the refund deposited into is going to be the account that gets both of their stimuluses based on the 2018 tax return, because neither had filed their 2019 return yet.
Right.
And so now what happens is one spouse received both stimulus payments. The other spouse didn't receive it because they hadn't yet filed their tax returns to tell the IRS that they were separated or divorced and all that kind of stuff. And so you can imagine in that scenario, now you have to contact your ex-spouse to try and get your $1,200 stimulus from them, and recipe for disaster.
One example of them. There are other examples.
Yeah,
I'm sure
absolutely.
We can fabricate them, but just wait 6 weeks and we'll have plenty more.
Yeah, exactly. And we don't want to, like Charlie said, we don't want to belabor that point too much. But we just want to mention that is going to be part of what's happening. When you call the IRS and you're on hold for an hour and a half and then they just hang up on you because they have too much call volume, it's people who are calling to ask those questions, and they just don't have enough people to be able to advise them correctly and efficiently. So, okay. So I think that covers the first and second round stimulus. Mm-hmm. So an easy segue is now, excuse me. Yeah, in regards to the third stimulus. So now we're talking 2021. Right. We are beyond the scope of the 2020 filing. Now what we're trying to talk to you about is not,
here's your crystal ball. Here you go. Yeah, now you can have it.
Shouldn't impact the 2020 filing. Now what we're talking about, hopefully, is informational stuff that will help you and that you're going to hear a lot about and that you can rely, by and large, in the information that we're giving you. If we tell you that you need to consult with somebody, then it's going to depend on your circumstances, and a lot of things do depend on your circumstances. But essentially, what we're trying to give you right now is the Don't read the Washington Post article. Don't, go to Bing. Don't listen to your neighbor. We're trying to give you the at least the shallow information that we know right now.
Did you say Bing?
Yes, exactly. Not Google, Bing, right? Have you ever tried searching Google first for something and then searching Bing and seeing the results that you get? It's really shocking. You should try it sometime because the Bing results are so strange in comparison. I'm not sponsoring Google. They don't sponsor our podcast, but I'm telling you, the results, if you search for both, are very unusual. So you should try it sometime. But we digress. So coming back to the issue at hand, talking about the third stimulus, this is part of a $1.9 trillion kind of omnibus package, a bill called the American Rescue Plan. That includes a lot of stuff. We are not going to cover everything in the American Rescue Plan today.
It has not yet passed.
Yes. As of February the 19th.
As of right now.
Yes.
That's correct.
It hasn't passed, but they're hoping to pass it very soon. It could be next week. It could be the week after, but it should be pretty soon. It's going to include 4 particular things that we're going to talk about today, and we'll go into...
pertain to taxes, I think. There's more things, but for that matter.
Yes, it covers a lot. We're only going to cover 4. But the first is, let's go ahead and just jump to, because we're segueing here, the third stimulus payment.
Sure. Really 2.5, but yes, third.
Yes, Charlie calls it 2.5, right. And I'll explain essentially the thought process behind that. The Democratic Party wanted to pass $2,000 stimulus payments. In fact, there was bipartisan support for the $2,000 stimulus checks when instead what was passed was $600 stimulus checks. What is now happening, President Biden is proposing the American Rescue Plan, which includes a $1,400 stimulus check. Well, they wanted to send out $2,000.
Right.
What was sent out was $600. Now we're just sending out the $1,400 difference, okay, of what we wanted originally versus now what is actually being sent out.
So just like amending that one to be...
Kind of. Not really, but kind of. So Charlie calls it stimulus 2.5. I don't. I call it round 3, but that's simply because we're not reporting this one on the 2020 tax return, right? It's a totally different year, right? So speaking to it, and please understand, and so I'm going to have to say this once, and then Charlie, you're going to have to agree with me, and then you're going to have to apply this information. You have to. I'm sorry.
Twist my arm.
Charlie hates when I paint him in a corner. He hates
feral cat.
Years and years of arguing. Charlie can't stand it. Okay, so but I am going to paint you into a corner, and you're going to deal with it because I'm going to tell you right now. Everything from here on out that we're talking about is subject to what actually passes.
Correct.
Please don't take this as 100% gospel. This is gospel for what we know right now, but not what may change.
Correct.
So some of these bills change dramatically from when they are originally proposed to when they actually pass. So all of this, grain of salt, take it. And we will...
That was easy. I don't have a problem with that one.
Yes, but I did paint you into a corner. It just was a corner that you agreed with.
Got my hair up and everything.
Okay, so third round of stimulus, $1,400 payments. First, let's talk about kind of the income ranges. So do you want to go over the income ranges and kind of what we think at this point?
So the income ranges, first, we have the original one, right? So to make it easy... Married couples starting at $150,000 of income. Anything less than that, you get everything, the full stimulus payment, up to basically $200,000. Between that was a proration, right? You can call it a phase out, you can call it a curve, you can however you want to do it, but it was a portion of it until you hit 0, right?
At now, essentially $200,000 or more, of which you got
0.
Goose egg. Nothing.
Correct. You make $500,000 a year, bully for you, no stimulus for you, right? You're a married couple, you make $35,000 a year, you get the entire stimulus.
Right.
Single people are half of that, 75 up to 100, right?
It was 99,000, but yes, essentially 100, yes.
And then married, head of household, essentially, it's in between.
Yeah, so 112,500 was the start of the phase out.
Right. So, and so that is... Currently, it has changed, right? So they talked about lowering it from, I'm just going to do the married numbers. They talked about lowering it from 150 to 125 as the start of the phase out, and then lowering it all the way to 100 as the start of the phase out, being that it would phase out completely by 125. So in the past number of weeks, it has floated between those three numbers. Our research today looks like it's back on the old initial
150 to 200 kind
which
of
would
range.
make it easy to calculate, as
Yeah.
in those numbers have been published many times
Yeah.
on round 1 and 2 of the stimulus. So if it was that, it just makes it easy and convenient to calculate and do because those numbers are already there. And so that's that, again, phase out. There's different terms. Commonly it's a phase out. That's a tax lingo
Yep,
thing.
yep.
Is calling it a phase out. But in my attempts to communicate with the clients, people that I meet, we'll use different terms. And so phase, fade, they said curve,
yeah.
or
Proration.
Proration,
Yeah.
yeah. So just
Whatever you
somebody
jive
gets
with.
it. Right.
Yeah, whatever makes sense to you.
Get the thesaurus. Oh.
There you go.
This
So forget that. Just pull out the phone with the thesaurus. Come on, Charlie. Whipping out the book here. What do you think we are?
Books are great.
No, they are. I love books. Okay. So we talked about the income phase-out ranges. You can find those very easily. We need to simplify this as much as possible. So
Yes.
we're talking about the married filing joint numbers, and again, it's just half of that for single. And then the amount is $1,400. So now the question is, who gets it?
Yeah.
Okay. So now to answer that, essentially. And this has changed a little bit because round 1 and round 2 of the stimulus
Were different.
they were different than this one, right?
Well, they were different in themselves.
Well, the amount was different,
And
but who received it was not.
correct.
Yes, so who received it were dependents who were under the age of 17 and the taxpayers themselves. So the spouses, right? If you were married, the two spouses, and then whatever children under the age of 17 that you had would receive it. But 17 plus, right? The age of 17 plus, college age students, young adults, that kind of stuff,
Right.
did not receive a stimulus payment.
They didn't get their own, nor did the parents get bonus stimulus for them being listed on their tax return.
Yep, and I got that question all the time. Well, should I be claiming them then? Because it's like,
Right.
it's not really a pick and choose your own adventure book situation, right? This is one of those.
Those were really fun.
I know, but they were kind of repetitive. You couldn't read them too many times.
That's true, but they were still fun.
Because you always ended up on the same book, right? Or on the same page. It's like you'd make a different decision and like 3 different times, and then you jump to the same spot. And I was always kind of disappointed that it wasn't enough different books. But we digress again. Okay, so essentially, who qualifies for this? Okay, now, because we can talk about before, and we did talk about that in a previous podcast, but let's focus more on who qualifies for it now,
Yes.
because it is different. What they are saying, again, grain of salt, take it, because we don't know where necessarily things are going to go, but what they're saying right now is that everybody qualifies for the
Regardless
$1,400.
of the age.
So young adult children, college-age students, if they are a dependent on your tax return, you will get the $1,400 for them. That part I do not think will change because they need to be able to track this
It
electronically.
makes it really convenient. You're not
Yeah.
wrestling over the should they claim themselves this
Yeah.
year or not. That'd be just
Yeah, and technically you can't just choose whether you want to claim yourself or not. The
Right.
question is, do you provide more than 50% of your own support? No? Then you don't claim yourself, right?
Sure.
You are a dependent.
correct.
And manipulating that to get the better stimulus amount technically is defrauding the federal government, because it's untrue. And so, but anyways, we won't go into that because that will be a whole nother 20 minutes of soapboxing.
I'm proud of your restraint.
Thank you. So anyways, we talked about the income ranges.
Yep.
We talked about the amount. We talked about who's going to get it. So should be a whole lot easier this year of who's going to get it. It's kind of a blanket of everyone.
Right. So
Except
potentially the biggest wave that will come
Yes.
of them. And so, because that very first wave was like 1,200 for the
1,200,
taxpayers and 500
500, yep.
per person or need.
and this is 1,400
for
across
all of them. So
Yep.
if it's a married couple with like 3 kids, you're talking about a sizable number.
$7,000 stimulus payment.
Yeah.
Yeah.
Which is catch up to 2.5. Right. In addition to the other people. Anyway, yes.
Yep.
So I think we're good on stimulus.
Okay.
Yeah. Okay. Or any more you want to talk about that one? Because there's a lot to it.
No, I think that essentially
We got
covers
the
it
three
right
pieces.
now. Yeah, just again, grain of salt. Take everything we're saying with a
Yeah.
grain of salt until it actually passes.
Correct.
Okay.
So the bill, the American Rescue Plan, did cover, we said 4 things.
4 things. 1 is down. We got 3 more.
3 more to go.
Yep.
But they're not as involved.
No. Are you taking the first one?
Sure. You have to pick what the first one is.
Sure.
Got a Wheel of Fortune.
Choose your own adventure.
You stop on X, child tax credit.
Okay.
So child tax credit, probably shouldn't do that, I shouldn't remember the number. But hey,
Why don't I
it's
take
gonna
that one?
change. Hey,
Yes.
I'll just choose what it is and you get to do it.
There you go.
That's easy. I'll take the next one just like that every time.
Painting me into a corner. Okay. But
You thrive
I
there.
like being there. Yep. Back me into a corner. I like it. Okay. So the child tax credit is currently is $2,000 for each child under the age of 17.
Right.
What the proposed changes to this are, again, grain of salt, is $3,000 for each child under the age of 18. So it extends the year by 1
Yep.
and increases the credit by $1,000. I actually, and this may not be right, but I did read something just the other day about all of it being refundable instead of only a portion of it being refundable.
I was curious in that part if they were going to change that.
Yeah, so I don't know. Again, big grain of salt on that one because that was only a single source. I haven't.
It was odd to have in the
confirmed
2000,
that.
1400. It would be clean, but
Okay, let's not open that box. That's another conversation for another time. Essentially, only a portion of the child tax credit could be refunded to you
Right.
unless you had enough tax to meet it. Sorry, I know that's not a sufficient explanation, but we're not going to dive into that. That would take too long. But the child tax credit of $3,000 for each child under the age of 18
Right.
is what they're going to change it to. Now, I haven't looked to see when, at least how far into the future that change is going to be in effect.
Right.
But I do not believe that this is only a 2021 change. But I don't have any source to back that up. You haven't seen anything about how long this is going to last, is it?
No.
Or have you? Okay. So then, do you want to pick the next one for me to go over, Charlie?
Now it's an either or. Can I do eeny, meeny, miny, mo? Because
Yes, Charlie.
you have a theory on that one.
Charlie loves to do eeny, meeny, miny, mo. But what he doesn't want to hear is that whatever one you start on, it's the other one that it ends on.
Because you always pick mo. It just makes it really easy.
Okay, Charlie, which one do you want me to go over next?
The daycare credit.
Oh, okay. So it's called the dependent care credit, but for whatever reason, dependent care is not as clear as daycare. So we're going to...
I call it daycare, yes.
Yeah, we're going to call it daycare because that's really what it is. Essentially, so again, I have to explain what the daycare credit currently is versus what it's going to change to. Again, big grain of salt with this one. But essentially, the dependent care credit worked for children who are 13 or under. Technically, it's children who are 12 and under, but the year they turn 13, they can still qualify for some up until they are 13. But once you're a teen, the daycare credit is no longer applicable. And then what happens is you can spend up to a $3,000 max, which I know is a joke to some of you parents out there who are paying $20,000 for dependent care, right? But it's a $3,000 max for up to 2 children, meaning $3,000 each for a total of $6,000 cap.
Yeah, 5 kids in daycare, it's $6,000 cap.
Yep, $6,000 cap. It doesn't matter if you have 3 or 4 or 5, like Charlie said. It's 2 is the max, $3,000 each. Okay. Now, so what we're going to reference that as is the $6,000 cap. Okay, so that you understand when I tell you what the new cap is. But that's the $6,000 cap. Now, the way the credit works is there is a range at which you actually get a credit back on that $6,000. It's between 20% of the $6,000 up to 35% of the $6,000. But the reality here is the income, because it's based on income. The less income you have, the more percentage or the higher percentage you get of the dependent care that you spend back as a credit. But the income threshold is so low.
Basically, if you can work and afford the daycare, you're at 20%.
Yeah, then you're going to end up with 20%. So I personally, I should say professionally, have never seen someone get more than the 20% credit.
I don't think so either. I mean, honestly,
I've never seen it.
Yeah.
But of course, there are people who may.
It absolutely happens.
Yep.
Yeah.
And so the issue here is what I'm going to reference this as is the $6,000 cap and a 20% credit. But what I need you to also hear is that there's this higher version of the credit,
Right.
which is 35% that we just don't see very often.
Right.
Now, to explain what it's changing to,
Right. Why that matters to us.
yep, is it's now an $8,000 cap instead of a $6,000 cap. That is $4,000 per child for up to 2 children, right? And it is the credit. What they're saying is 50%.
Up to.
Right. So are they saying 50% from 20% to 50%, or are they saying from 35% to 50%?
And one of the sub ranges in between.
That's
there,
right.
And
So that we don't have an answer to at this point. Until it passes, we won't necessarily know for sure.
so at a glance, you see 50%. You're like, hey, this is amazing.
From 20 to 50 is awesome.
Correct. But then when we look at it, we go, but there's a lot more context here
Yep.
that we don't have.
Yep. So tough to tell you for sure. Just know that that's what we know at this point. The other piece to this is that they are making this credit refundable. Refundable matters when you have Charlie, gosh. So when you have all of this income, right? You have X, whatever your income is, X, and then you have deductions to bring down your income. You're taxed after all of your deductions. If after all of your deductions, and then we've got your taxable income, your tax is $2,000, for example.
Right.
And you have child tax credits of $4,000. Your credits can only offset tax. So if your tax is $2,000, your credit, you can only use, of the $4,000 child tax credit, you can only use $2,000 of it to offset the $2,000 of tax.
To get your tax to 0, which is
the goal. Yay.
Right.
But then a portion of the child tax credit is refundable.
Not all credits are. Some
That's
are
right.
special.
The daycare credit has never been refundable to my
Correct.
knowledge. They are now making it refundable. So the child tax credit in the scenario that I discussed, you have $2,000 of tax, you have a $4,000 child tax credit. We get rid of the tax, we get rid of the credit, we're left with $2,000. That gets treated as a payment, and a refund on your taxes is a refund of your payments.
For simple math.
It's money you paid in.
Stuff is weird because we talked about that earlier.
Yeah.
But for simple math, to make it
In that scenario, it does work, but we're not going to dive into the more complicated stuff. Thank you, Charlie, for mentioning that it's always more complicated than we make it seem, because it is,
It's
right?
awesome.
And we are, yes. Yay. And so that's...
Never let that go.
No, I'm not. And Charlie and I have known each other for a very long time, and I will remember that. And so anyways, that $2,000 of the child tax credit comes back as a payment. Even if you paid nothing in federal income tax withholding, nothing, you would get a $2,000 refund, because that $2,000 is treated as a payment.
Right.
So the point here is, because that's a lengthy explanation for the
Correct.
easy point, which is the daycare credit is going to change to be refundable, which means you can actually get more back than what you've paid in if you have this credit.
Does not affect everybody, but will affect some people.
Yep,
Yes.
absolutely. Okay, so we've got one more. What's the one more, Charlie?
Unemployment.
Okay, do you want to cover this one?
I'll try.
All right.
So the unemployment, CARES Act added some unemployment, they call it like insurance, right? Just
Yeah,
the
unemployment insurance, yeah.
strong-arming unemployment to pay you for a longer duration, great. And then there was a period where it was a bonus amount, right? An extra infusion per week from the federal government of an amount, which stopped, correct? Or it's still going right now?
So should I take this one too? Essentially,
I don't know the history stuff. I just know what it's going to change to.
Essentially, it started at $600 a week on top of the regular percentage of your your salary that you would receive, or your income benefits. That's right. There was a period of time only that you could receive it. I think it's 10 months. I have never personally been on unemployment since I've worked here since I was 10 years old. So I can't speak to that piece of it. But essentially, it was an added $600 a week. Then that expired.
Right.
and they passed an extender, if you will,
thing.
but it dropped it from $600 a week to $300 a week. So your regular unemployment benefits plus $300 a week, that is set to expire on March the 31st of 2021.
Oh.
What they're trying to do is pass the American Rescue Plan before March the 31st of 2021 to extend the unemployment insurance, to increase it from $300 to $400 a week,
Right.
and it's going to go until September.
Got it.
That's the gist.
Got it. That's the whole thing. So
Sure.
the question I have, genuine question, I don't know, is how long can someone collect the unemployment for a period? Because there's a period of time where you just have to stop.
I do believe that it's either 10 or 12 months.
Got it. Okay.
Clark, you don't happen to know, do you? Our producer,
So someone
Clark.
had like started it in like March of last year when
Right.
the pandemic started, is not going to be able to take it all the way through.
I don't know the answer
We're
to
not
that.
experts in that one.
Yeah, I don't actually know
but-
the answer to that. I
Right.
do believe that you
600, 300, then 400.
I do know that there used to be a cap.
Right.
They have since removed that.
Because of all this.
Yeah. So don't take us as experts on unemployment. I deal with it on an income tax basis, and that's essentially it. I don't advise people on how to receive unemployment benefits, how long they can, how to extend them, that kind of stuff. So
And that's the rub with this whole thing is, like I'm attributed to cancellation of debt. We're not going to go a bunch into it. It's just,
oh gosh.
generally speaking, unexpected income that you have to report on your tax return.
Yeah.
So unemployment is not tax-free. It is absolutely income that you report on your tax return. You get a tax form about it. A lot of folks are getting surprised by seeing these tax forms with that bonus 600. I had my own nephew who was happy to be on unemployment because he was receiving more on unemployment than he was when he was actually getting paid. And then he's going to get his tax form for a larger sum than he would have expected, more than zero. But
Yeah.
anyway, and then we came across something recently where they're contemplating some legislation. It's like a theoretically it could happen.
So
type of
let me
deal.
preface this just so that you understand. Probably 9 years ago, I think it was about 9, maybe 10 years ago, there was a bill proposed for a grooming credit.
Oh, sure. Okay.
The grooming credit was for people with a mustache. You get a $250 credit. This is what our Congress people are spending their time on?
Right.
Are you kidding me?
That made a lot of traction, didn't it? Like in most of the process.
No. It did not pass. It did not pass.
Then it mentioned through the process.
Yeah.
They got a lot of way
I
through.
couldn't
and then
speak
got
to that.
stopped.
I use this as a joke more than anything else.
Correct.
Yeah, I didn't do the in-depth research. It didn't pass. That's what I can tell you. Because we deal with what passes, not what could pass. Except for our wonderful content for you guys, because then we're worried about what can we tell you about what's upcoming. So, to not belabor the point, this mustache credit did not pass, but it was proposed.
Right.
Okay. In that same light,
Correct.
there is a current bill that has been proposed that does not appear to have bipartisan support that would eliminate tax on the first $10,200 of unemployment income that you receive.
Right.
So that's just a little tidbit. We don't know anything more than that. It just was recently proposed.
Right.
I
So
don't
if you
know.
have it, cross your fingers.
Yep.
That's about it.
I don't know if this will go through, but it could.
No idea.
So we just wanted to add that in as a little snippet of something we just learned about last night.
Right. So unemployment was one of the pieces. Clearly don't know, not an expert on gaining it, having it, how long it is, but it is income. It's a thing that has to do with this bill that does affect taxes. We included in our 4 points.
Yep, absolutely. So that covers our 4 points. Was there anything else in regards to the American Rescue Plan that you want to cover?
No, that I wanted to cover. No, there's a lot of things. Yes, that we're all to it, but
Yes, a lot more to it than what we have discussed. Again, grain of salt. So eliminating that, I think we've covered all of the major points we wanted to talk about today, but it wouldn't be questioning your sense without the comfort zone. So Clark, what do you have for us today?
I have one question for you today. How long does it take to get your tax refund back?
Okay.
different answer or different question, Trebek?
No. No. Yes, because Jeopardy, that's when they'll give you a different answer than the
Yeah,
one
I
you
want a
asked.
different one.
Or a different question.
Change the subject.
No, this one actually, honestly,
bad.
is pretty straightforward. And the answer is still it depends, because the answer is it depends
Correct.
for everything. But did you file electronically? If the answer to that is yes, and if your tax return did not reject or have other issues, generally the answer is 2.5 weeks. Now, the reality is a lot of refunds are sent out a week from acceptance, the electronic filing acceptance.
Right.
A tremendous amount of them. The IRS guidelines is 2.5 weeks. But it gets more complicated.
To add into that one, it won't matter as much this year because of when they opened the electronic filing on February 12th. But there are those who have specific refundable credits.
Like we mentioned earlier, the refundable ones.
Refundable credits.
You're getting more back than what you paid in.
That they will intentionally delay until February 15th. So even if someone, let's say in 2 years, is able to file electronically on January 20th, and you have any of these things in your tax return.
The child tax credit is one of them. I would imagine the daycare credit, if this change is in place, I imagine they might add that one.
Income tax credit type of thing. They just won't even process your refund until February 15th, period. So there are some folks who will have a delay right now as of this recording for the 2021 year, for 2020 tax year. You file electronically, you're gauging in a couple of weeks. There was, not too many years ago, the IRS used to publish, if you filed by this date, your refund will happen by this date. And then with banks having different hours of operation, all that kind of stuff, it was never exact, and people were frustrated and more calls to the IRS, and so they just stopped promising. So you probably can go back on the internet and find old promissory dates. You can't rely on it. They just stopped doing the promises. They're still mostly pretty true, but you can't rely on it.
Well, and actually, it's faster in some cases because they took those processed tax returns and processed them. That's kind of redundant, but they did it like Wednesday night at like 12 a.m. or something like that, or technically Thursday morning. And so if you didn't meet that drain, then you had to wait until the next week.
Right. So you filed on Saturday, you had to wait for the Thursday pull.
But now, if you file on Saturday, it's just processed starting on Saturday. So
that's what it feels like.
I hear you, feels like, but I think the reality is people in that scenario are getting their refund sooner than they would have under the old system.
Right.
I just think the IRS changed the way that they did this entirely. And so it really has felt very consistent as far as when you get your refund. Now, there's the one aspect that Charlie is talking about in regards to they've been delayed. And would you care to share with the class why they made that change, Charlie?
Because they hate letting money go. That's basically what it is.
No, that is not the reason
totally
why.
What it is. Like, we give all this money in the beginning of the year and don't get anything else afterwards. We have to gate this just a little bit. So no refunds until this date.
No, that's not why. I'm actually surprised you don't know this. So the reason why is because of all of the fraudulent tax returns that were filed. So they have deliberately delayed certain
mine is true to a degree, but yours is also, I think,
I would love to see evidence to support your theory.
Happy to.
Good. But this change was made just after all of those fraudulent returns. That one year where they sent out like $26 billion of fraudulent refunds. I mean, it was unreal how much federal government money went out because people were gaming the system. And so that was the year that the next year they delayed the filing of refundable credits because that was the trick. I didn't pay anything in. I do qualify for a refund. And so there was nothing to match to stop the matching and all that kind of stuff. So they were getting these credits and it was a mess. But beyond that, it also depends on how you file. Because what if you file on paper? If you file a paper return right now, you're talking 6 months before the return is processed. It can take 8 to 12 weeks
on a regular,
and they're saying 3 months added to the regular expectation. So we're probably talking 6 months before your tax return is processed. That's not even talking about when they're going to send you a paper check in the mail. So it could be another month after that. If you file an amended tax return, essentially the same thing. It is going to be so long, unless, thankfully, they give us the opportunity to, starting in August of last year, electronically file some amendments. So that's actually kind of exciting, but we won't go too far into that because I think we've already beat this dead horse. Answered the question. Clark, does that meet your expectations?
Yes.
Okay, fantastic. Then I think we'll go ahead and leave you guys there. Really appreciate you guys joining us for this kind of special session of Questioning Your Sense. Mid-tax season, really, really crazy busy time for us, especially because we're just coming off of this Texas power, debacle and all of that kind of stuff. So we appreciate you guys being with us, and we look forward to seeing you next time. This has been Questioning Your Sense with Kevin Molen and Charlie Steinmetz. Have a great one.
Thanks for tuning in to this episode of Questioning Your Sense. If you haven't done so already, be sure to subscribe to this podcast, leave us a 5-star review, and don't forget to share it with a friend. If you would like to submit a question for our review on this podcast, feel free to email us at info@molentax.com.